Welcome everyone to our discussion on lending, where the old world of banks meets the new frontier of crypto. Let's kick this off by looking at traditional lending, where regulated banks work through rigorous processes to evaluate creditworthiness.
Yep. So in traditional lending, you've got all these credit checks and forms to prove you're creditworthy before you can get a loan, right?
Exactly, it's like you need to show a solid history of repayment, and if your credit score isn't up to par, well, you might not even qualify or get a higher interest rate. It's all very methodical and regulated.
And these loans often require collateral, like a house or car, to back the borrowed money. So there's that safety net in case of default.
Right. The collateralized nature of many traditional loans gives lenders a sense of security because if you're unable to repay, they can seize the asset. It's a system with lots of consumer protections, which is both a strength and sometimes
Yep.
a limitation.
Limitations, can you expand on that a bit?
Sure, because while the heavy regulation means you get well-defined processes and consumer safeguards, it also means that people with poor or no credit history can essentially be locked out of this system. There's a conservative approach. If you're not deemed creditworthy, you're excluded.
That makes sense. Now, switching gears, crypto lending seems to be a whole different ballgame.
Absolutely. Crypto lending is fascinating because it operates in a much less regulated space. Instead of traditional credit checks, borrowers use their digital assets as collateral to secure a loan. They can get either crypto or even fiat loans.
Right. And this process is often like super fast compared to the old school approach, isn't it?
Yeah, it's often near instantaneous because it relies on blockchain technology and smart contracts to verify and execute the loan terms. There's no need for lengthy paperwork or credit bureau checks.
That's really appealing for a lot of people, especially those without a strong credit history or the luxury of time to wait through traditional processes.
Exactly. Plus, you have two distinct flavors in crypto lending, centralized and decentralized. Let's break those down a bit.
Yeah. So, centralized crypto lending platforms are operated by a single entity, kind of like a mini bank in the crypto space, that acts as an intermediary between lenders and borrowers, right?
Yes, precisely. They manage the process, charge fees, and use smart contracts to enforce the terms. On the other hand, decentralized platforms or P2P lending protocols let everything run automatically via smart contracts with less human intervention.
And the decentralized approach is kind of the Wild West. It's all automated, but can be risky if there are bugs in the smart contracts.
Exactly. It's like handing over the keys to an algorithm. The benefit is speed and a huge potential for higher interest rates on your crypto assets. But there's risk, both from technological vulnerabilities and the inherent volatility of crypto.
I see. Speaking of volatility, isn't one of the big risks in crypto lending the rapid devaluation of collateral?
Absolutely. Crypto prices can swing drastically in short periods. So imagine if your collateral suddenly drops in value, and now your loan to value ratio is off. It can trigger a forced liquidation by the lending platform.
That seems like a double-edged sword. On one side, you're getting higher returns, but on the other, you're exposed to significant risk compared to traditional loans.
Precisely. There's this trade-off. Traditional lending gives you consumer protection and a stable, regulated environment, while crypto lending offers a chance at higher interest rates and quick, frictionless transactions, but with a lack of regulation that can leave both lenders and borrowers vulnerable.
Yep, that balance is crucial. One intriguing point is that crypto lending gained traction during the COVID-19 pandemic. People were looking for ways to earn a better return on their assets, since typical savings products were practically yielding peanuts.
Exactly. It was like a lifeline for crypto owners to put their assets to work without, selling them. It also opened up ways for the unbanked or those with poor traditional credit to access loans using their digital currency as collateral.
Very innovative. But then regulation comes into play again. Some countries have already taken steps to prohibit or heavily restrict crypto lending, right?
Yes, that's a big potential twist. As governments start putting frameworks in place, there's a chance that crypto lending could face severe restrictions, much like traditional lending does. But ironically, with less consumer protection if those regulations don't keep pace with the risks.
Yeah, I can see that challenge. And here's one area where I kind of respectfully challenge your point. While traditional lending is undoubtedly safer due to regulation, it also tends to be less accessible to everyday citizens who might not meet strict credit criteria. Isn't it kind of unfair that those with fewer resources are being left out?
That's a fair critique. Traditional lending does offer stability, but the flip side is rigidity that can limit access. Crypto lending fills that gap by offering an alternative route, although it brings its own set of hurdles like volatility and tech risks. So, in a way, each system is balancing risk with reward differently.
Exactly. And then there's the interest rate aspect. Traditional loans have narrowly varying rates controlled by central bank policies, while crypto lending rates can be much higher. But those rates come with a risk premium, don't they?
Yep, you hit it on the head. Traditional banks adjust rates based on Federal Reserves and competitor actions, usually leaving little room for deviation. Crypto, on the other hand, has more dynamic interest rates driven by market demand and the inherent risk of the asset itself. It's like trading safety for potential profit.
That's a neat analogy. And what about smart contracts? They provide a great deal of transparency and speed in crypto lending, but they're not without flaws.
Right, smart contracts are revolutionary in automating loans, but any bugs or vulnerabilities in these contracts could be catastrophic. It's a high-stakes gamble on code. That said, they do eliminate human error in processing, which is a plus.
True, both good and bad. So, if we summarize this a bit, we see that traditional lending offers a tried and true, heavily regulated approach with built-in consumer protections, albeit with limited accessibility for some. Meanwhile, crypto lending provides faster, more open access to funds, harnessing blockchain and smart contracts, but with pronounced risks related to volatility, potential security breaches, and minimal regulatory oversight.
Exactly. It's like you're choosing between a slow and steady but safe method versus a quick, high-risk, high-reward scenario. Each has its audience and its challenges.
Yep, very well put. And considering the evolving nature of global regulations, we might see crypto lending tighten up in the future, which could fundamentally change its risk profile and even its appeal, right?
Absolutely. Regulatory changes could bring more stability and perhaps even consumer protections closer to what we see in traditional banking, but with the novelty of blockchain tech still intact. It's an exciting space to watch.
Right on, very exciting indeed. It's fascinating how these two systems coexist in today's financial landscape, each offering different pathways for borrowers and lenders alike.
Yes, indeed. Whether you're sticking with the old guard or venturing into crypto territory, both systems highlight the evolving nature of finance, a real tug of war between stability and innovation.
Absolutely. Thanks for this deep dive. It's been really illuminating to dissect the nuances between traditional and crypto lending.
My pleasure. It's always great to explore how these two worlds compare and contrast. Until next time, keep questioning and exploring these financial landscapes.
Right, see you next time.